This is one of the reasons we were a little bit hesitant coming into this quarter, because it was clear we had headline risk, all kinds of macro risk out there that was going to be a hindrance to the market. Having said that, we believe that the path of least resistance here is upward, just because you have so much liquidity coming into the system, and in the end, the earnings for the third quarter have not been as bad as feared. It's true that 2020 earnings have to come in, but with some growth at all, you should see appreciation here. So even though today's one of those days where it's, play defense and sell cyclical and sell anything that feels like levered to global growth, I feel like it's the noise, and the real signal is to move upward.
Dan, how do you feel about that? Yeah, earnings are better than expected, but look at this economic data that we're getting.
Yeah.
That's weakening. That doesn't look so great. This trade deal seems like, it is really affecting market sentiment.
So I think about it this way. So the last 2-3 months of last year, the S&P 500 fell off a cliff. It dropped 20%. Estimates for 2019 across the board got slashed, earnings estimates. So here we are. This whole year, we've been making them back. We've been doing better than the low expectations were as estimates came down in the first half of 2019. So when I think about it on a corporate level, I'm not particularly impressed. That chart right there is really interesting to me because we've had two incremental highs, not including this one we just made this week. Like I just said before, they've come in this earnings period as we've rallied into it. And what have we seen? We've seen two 7% or so peak to trough declines from that. So when I think about that, that's not too encouraging. That doesn't make me buy new stocks at highs. I will say the one difference is the dollar, the Dixie. Did you see how it sold off over the last few weeks? That's actually very good for multinationals, especially as they have this headwind of the trade issues.
Alicia, it feels like the reaction to the Fed yesterday has been risk off, even though the expectation is that it was quite dovish and there could be more cuts to come. Where do you stand on that, and what does it mean in particular for the financials, which are suffering today?
That's right. So going into yesterday, all the expectations were we were going to get 25 basis points and then the Fed was going to hold. Today, it looks like the market's pricing in probably another 25 basis point cuts in the next few months, simply because you still have the inversion on the 3-month, 2-year Treasury. So the thing is, the risk off is because the market doesn't feel that the Fed's going to cut enough, given what's going on globally. So you had GDP coming out of Europe today. You had lousy PMIs. So in the end, we're still exposed to the lousy global data. I'd say this. It feels that the global data is, in a sense, bottoming. Not that it means it's good, and not that it's inflecting, but that it's bottoming. And if you look at yields globally, they're off the lows, which suggests that we're moving upward at some point.